In the dynamic world of business, companies constantly seek new avenues for growth and expansion. These ventures often demand substantial investments in long-term assets, a process known as capital budgeting. From launching innovative products to acquiring cutting-edge machinery, capital budgeting decisions shape a company's future trajectory. At the heart of sound capital budgeting lies the accurate estimation of cash flows. Cash flow, the lifeblood of any business, represents the inflow and outflow of money. For capital budgeting, we focus on relevant cash flows, those directly affected by accepting or rejecting a project. This essay delves into the intricacies of cash flow estimation, providing a comprehensive roadmap for making informed capital budgeting decisions. Imagine a company contemplating the purchase of a new manufacturing plant. This decision hinges on whether the future cash inflows generated by the plant outweigh the initial investment and ongoing operational costs. Accurately forecasting these cash flows is paramount to determining the project's profitability and ultimately its viability. Mastering cash flow estimation empowers businesses to allocate resources judiciously, maximizing returns and driving sustainable growth. By understanding the principles and techniques involved, companies can navigate the complexities of capital budgeting with greater confidence. In the realm of capital budgeting, not all cash flows are created equal. Only those impacted by the decision at hand are deemed relevant. This principle of relevance serves as our compass, guiding us to consider only the cash flows that truly matter. Relevant cash flows are those that differ between accepting or rejecting a project. These incremental cash flows represent the true financial impact of our decision. For example, if our new manufacturing plant allows us to generate additional revenue of $1 million per year, this increase in cash inflow is considered a relevant cash flow. Conversely, sunk costs, those already incurred and irretrievable, are irrelevant to our decision. Imagine we spent $50,000 on market research before deciding on the plant. This cost, while real, is irrelevant because it cannot be recovered regardless of our decision. By focusing solely on relevant cash flows, we eliminate distractions and gain a clearer picture of the project's true financial consequences. This disciplined approach ensures that our capital budgeting decisions are grounded in a realistic assessment of the project's potential. Incremental cash flows, the lifeblood of capital budgeting, are crucial for making informed financial decisions. They encompass all changes in cash flows directly attributable to a project, providing a clear picture of its financial impact. These cash flows, both inflows and outflows, paint a comprehensive picture of the project's financial impact over its life. Understanding these flows is essential for evaluating the project's potential success. To navigate this terrain effectively, we categorize incremental cash flows into three primary types: initial investment outlay, operating cash flows, and terminal cash flows. Each category plays a distinct role in the financial analysis. The initial investment outlay represents the upfront costs associated with launching the project. This is the foundation upon which the project is built. This includes the purchase price of assets, installation expenses, and any increase in working capital required to support operations. These costs are often substantial and need careful planning. For our manufacturing plant, the initial investment outlay might encompass the cost of the land, the building itself, and the machinery needed for production. These are significant investments that set the stage for future operations. Operating cash flows, the heart of the project, reflect the ongoing cash inflows and outflows generated during its operational life. These flows are critical for maintaining the project's viability. This includes revenues from sales, expenses related to production, and any tax implications. Monitoring these flows ensures the project remains profitable. For our plant, operating cash flows would include sales revenue from the products manufactured, minus the costs of raw materials, labor, and utilities. Efficient management of these costs is essential for maximizing profits. Finally, terminal cash flows capture the net cash generated at the project's end. These flows mark the conclusion of the project's financial journey. This includes the salvage value of assets, the release of working capital, and any tax implications arising from the sale or disposal of assets. Properly estimating these flows can significantly impact the project's overall profitability. In our example, the terminal cash flow might involve selling the plant and equipment at the end of its useful life. This final step recovers some of the initial investment, and concludes the project's financial cycle. By understanding and accurately estimating these three categories of incremental cash flows, we gain valuable insights into the project's financial viability and its potential to create value for the company. This comprehensive analysis is crucial for making informed investment decisions and ensuring the project's success. In conclusion, navigating the terrain of incremental cash flows requires a thorough understanding of each category and its impact on the project's overall financial health. By meticulously analyzing initial investment outlays, operating cash flows, and terminal cash flows, businesses can make strategic decisions that drive growth and profitability. With careful planning and accurate forecasting, companies can turn potential projects into profitable ventures, ensuring long-term success and sustainability in a competitive market. As we delve deeper into the nuances of cash flow estimation, it's crucial to recognize the pitfalls of sunk costs and the importance of considering opportunity costs. These concepts are fundamental in making sound financial decisions. Sunk costs, those already incurred and irretrievable, can be alluring distractions, tempting us to continue with a project even when it's no longer financially viable. This often happens because we feel emotionally attached to the investments we've already made. Imagine we've already invested heavily in developing a new product, only to discover that market demand has dwindled. The market conditions have changed, and our initial projections no longer hold true. The temptation to continue to salvage something from our investment can be strong. We might think that pushing forward will eventually turn things around. However, succumbing to this sunk cost fallacy can lead to further losses. It's a trap that can drain resources and time, which could be better spent elsewhere. We must acknowledge that past expenditures are irrelevant to the decision at hand and focus solely on future cash flows. This shift in perspective helps us make more rational decisions. Opportunity costs, often less tangible but equally important, represent the potential benefits forgone by choosing one alternative over another. They are the hidden costs of missed opportunities. Suppose we have limited capital and must choose between investing in our manufacturing plant or expanding our existing product line. Each option has its own set of potential returns and risks. The opportunity cost of choosing the plant is the potential profit we forgo by not expanding our product line. Conversely, if we choose to expand the product line, we miss out on the benefits of upgrading our manufacturing capabilities. By explicitly considering opportunity costs, we make more informed decisions, ensuring that we choose the project that offers the highest potential return on our investment. This approach helps us allocate resources more efficiently. This holistic approach, factoring in both sunk costs and opportunity costs, leads to more strategic and profitable capital budgeting decisions. It allows us to navigate the complexities of financial planning with greater clarity and confidence. In the intricate world of capital budgeting, where every decision can have far-reaching consequences, some costs are not immediately apparent but can significantly impact a project's profitability. These hidden costs often lurk beneath the surface, waiting to be discovered. Externalities and cannibalization represent two such hidden costs that demand careful consideration. They are like the unseen currents in a vast ocean, influencing the direction and success of our financial ventures. Externalities, as the name suggests, are costs or benefits imposed on other parts of the company or on society as a whole, not reflected in the project's direct cash flows. These can be both positive and negative, and their impact can be profound. For instance, our new manufacturing plant might generate pollution, negatively impacting the environment and potentially leading to future cleanup costs. This environmental degradation can also affect the health of nearby communities, leading to additional social costs. Conversely, the plant might create new jobs, boosting the local economy and generating positive externalities. These new employment opportunities can lead to increased spending in the local market, further stimulating economic growth. Cannibalization occurs when a new project eats into the sales of a company's existing products, reducing overall profitability. This internal competition can be detrimental if not properly managed. Suppose our new manufacturing plant produces a product similar to an existing one. The overlap in product offerings can lead to a split in customer preference, diluting the market share of both products. In this case, the new plant sales might cannibalize those of the existing product, leading to a smaller than anticipated increase in overall revenue. This reduction in sales can affect the company's bottom line and strategic goals. Accurately accounting for externalities and cannibalization can be challenging, but is essential for making informed capital budgeting decisions. It requires a deep understanding of both the market and the broader societal impacts. By quantifying these hidden costs, we gain a more comprehensive understanding of the project's true financial impact, allowing for more accurate profitability projections and better informed investment choices. This holistic approach ensures that we are not just looking at immediate gains, but also considering long-term sustainability and ethical implications.